Okay, so we are now doing risk management. I'm doing right now chapter 7, okay, which is called Risks of Financial Intermediation. In this chapter, we'll provide a short survey of the different risks. And we'll cover what's called the Big 10 risks. Number 1 is interest rate risk. I'll just shorten it to IR. Interest rate risk. Interest rate risk is the risk associated with mismatch of maturities. So you need to understand the concept of maturity. Maturity is the length of time for which a security expires or for which a security is due. So, interest rate risk is most commonly associated with borrowing short and lending long. I'll be explaining that in a minute. Number 2, market risk. Okay, market risk is associated, or the risk associated with both assets and liabilities. In other words, it's the change or unfavorable change of price of both or either assets or liabilities on the balance sheet of a financial institution. That's market risk. It's associated with possibly changing interest rates, so bond prices can go up or down. It's associated with stock market changes. Stock market goes up or stock market goes down. In other words, it's associated with general movements of securities. Okay? Next one is credit risk. And credit risk is simply the risk that credit will not be paid back on time and in full. Okay? When credit risk materializes, we call it default. Default is the inability to serve your obligations on time and in full. Next, off balance sheet. Risk. Off balance sheet risk is associated with assets, but almost always with liabilities which are not on the balance sheet. A lot of times, liabilities are not on the balance sheet because their value cannot be determined well. It cannot be determined well because the liability may happen or may not happen because it's associated with something that's uncertain on risk. A liability that might happen or might not happen is called contingent. Liability. So it is most commonly associated with contingent liabilities. The most common one is having a derivative, and the derivatives may turn out to go horribly wrong, way beyond what was originally expected. A lot of times financial institutions want to keep derivatives off the balance sheet. They may want to keep certain other guarantees, warranties, and so on. Again, there's going to be a chapter on this to cover. Next one, forex, or foreign exchange risk. Is the risk of an unfavorable movement of the currency that will either devalue significantly your assets, meaning reduce the price of the assets, or increase the value of liabilities. We already spoke when Thailand financial institutions had borrowed in US dollars. When the Thai baht fell down, the assets were in Thai baht were depreciated, and the dollar value of the liabilities went up. So, meaning they had it's called a currency mismatch. And suddenly the liabilities were significantly higher. Well, today, the biggest currency mismatch in the global financial crisis will be China, where Chinese banks have borrowed significantly in US dollars, but lent locally in Chinese yuan. We're talking in the trillions. And when the Chinese yuan devalues, this means the whole Chinese banking system is likely to go bankrupt in a boom, like that. Next, country risk. When you say a country risk is the same as sovereign risk, is an unfavorable change in the political environment in a particular country, resulting in all other sorts of risks. Like, there is a government revolution. A lot of American companies invested in Iran, and in 1979 or whatever, you had the Iranian revolution. A new Ayatollah comes and he says, we're going to take the oil companies now ours. We're going to nationalize the company. And they lost it all. In whatever, the 90s or the early 2000s, you have a new Russian leader, Putin. He says, oh, these are all oligarchs, going to nationalize the oil companies. And a lot of Western companies lost billions because of changing political environment, because of changing leadership, changing constitution, changing laws, okay? That can happen a lot, okay? The typical one is just a military dictatorship comes and they take whatever they want for free. 7, technology. I'd be happy to give any student a few bonus points if you provide me or tell me about a technology that doesn't break. I mean, sure, the watch breaks, okay, the camera breaks, you have a phone, right? It doesn't always work perfectly, right? The phone breaks occasionally. Of course, you all got cars and motorcycles, and they all break from time to time. And of course, the air conditioner, the projector, yeah, they work most of the time, sure. But when they don't work, right? You can imagine what happens when your bank card doesn't work or the bank records don't work, where everybody goes to the bank and it says, you've got nothing, right? You don't exist, right? So technology risk can simply mean that the computer system shuts down, that's the good part, or all the data for all the people is lost and irrecoverable. Technology risk could be hacker comes in and transfers the money to his account in some other country, in Switzerland. Okay, the money's all gone, right? That's a simple technology risk. And so on. Operational. No. Risk. That's number 8. Now, technology risk is part of operational risk. So operational risk is, and write it down very clearly, that existing technology. Number 2, auditing, monitoring, and other support systems fail to function properly or adequately. So, could be auditing, monitoring, or other support systems, okay? Because the support system, you may have all of your contracts, you're a bank, right? You put in all of your contracts, you put them safe in the basement, and then the basement gets flooded with water. And all of your contracts, and now the customer says, I'm not paying, and you don't have a contract to prove, because your contracts are flooded and destroyed, or your contracts were destroyed by fire, okay? Or worse, you just lost the contract, you can't find it because you got 2 million contracts, okay? So these are all operational risks. Number 9, liquidity. Risk. So what's liquidity risk? Is that a sudden surge in liability withdrawals cannot be met with sufficient funds. In other words, is insufficient assets, we call these assets reserves, to meet a substantial increase in liability withdrawals. In other words, people panic, they walk to the bank, want their money back, want their money from the bank, and the bank doesn't have it. I mean, it has some, but it doesn't have enough to fulfill everyone's demands. And number 10 is insolvency. Insolvency risk. First, only say insolvency is the inability to meet all obligations with assets. A completely different way of saying the same thing is that is the condition of liabilities exceeding assets. Of course, liabilities minus assets, the difference is capital. So, insolvency is the condition of having negative capital. Okay. And insolvency risk is the risk that the financial institution will not have sufficient capital. Usually 3, 5, but sometimes 10 or 20%. Okay, in other words, it's the risk that the financial institution will run out of capital. Okay. Now we move to, let's see where. We move to interest rate risk, number 1. Again, maturity is the period of time in which a liability becomes due. Okay. Maturity. Mismatch is the difference between the maturity of assets and liabilities. The measure of maturity is called it measures the sensitivity, but the measure itself is called duration. It's called duration. Duration measures the average cash flow or the average price sensitivity of a security to interest rate change. That's duration. To borrow short. Stands for to borrow short term. To lend long means to lend longer term. The reason for borrowing short and lending long is explained by the yield curve. Yield is a return on a security, usually on a fixed security. Yield curve is the return on a different security across different maturity. So, maturity of 2 years, 4 years, 6 years, and so on. So the yield curves gives you yields for different maturities of the same risk. This yield curve is called normal. Normal yield curve is a yield curve which is upward sloping. Upward sloping means that returns, yields rise with maturity. Okay? Normal is just a name because it happens most of the time. Okay? Banks borrow short to pay, they pay the lower yield and lend long to collect the higher yield. Okay? This is what they pay because they borrowed on 2 years, and when they lend on 6, this is what they get. Okay? And this little difference is called the difference. The difference between the yields is called yield differential. Yield differential is the yield difference between yield on long and yield on short maturities. This is the return for taking interest rate risk. Is the compensation for interest rate risk. When the yield curve inverts, inverted yield curve, short-term maturities rise above, short-term yields rise above long-term yields. Typically, yield curves invert during recessions. As in recession, it is a lot riskier to lend or borrow short-term. They may survive, they may not. So, inverted yield curves are usually happen during recession. Well, that's when interest rate risk materializes. In other words, that's when financial institutions accumulate losses resulting from interest rate risk. During recession, you got separately liquidity risk, separately credit risk. So during recessions, you have a lot of accumulation of a lot of risk, and that's when financial institutions usually go bankrupt. One of them is interest rate risk. Let's see what's next. Okay. In the textbook, they like to use to borrow short. The textbook says they are short funded. Short funded means their funding is with short-term maturities, with short-term securities. Let's see what else we got here. Oh, there's another risk arising from this particular problem of borrowing short. It's called refinancing risk. Refinancing risk is almost and can be almost like a liquidity risk, and I'll try to explain. It's tricky. Number one, refinancing risk means the following. Hey, the yield curve is upward and normal, but the yield curve could move upward. It could move like this. In other words, all interest rates in the economy rise as they did in the 70s. They rise from very low to higher, higher, and higher. Okay? So, you borrowed within 2 years, you're paying a small interest rate, but 2 years down the road, you must refinance. Because you lent the money for 6 years, you're not going to get your money up until 6 years. But after 2 years, you got to pay back. The way to pay back is to refinance. Now, what does it mean? Refinance. We just said to finance means to raise funds. To refinance means to issue new debt to pay back an old debt. In other words, you borrow money to pay back your money. That's refinancing. So, refinancing risk is the risk that when the time the obligation matures and the time comes to refinance, your interest rate is going to be significantly higher and above the return that you are still getting. So let's say you are paying 2% short term, you are collecting 4% long term, interest rates rise from 2 to 6%. When you refinance, you must refinance at 6%, but you're still collecting 4%. So your yield differential turns from positive to negative. If you have significant risk, interest rate risk exposure, you go bankrupt. That's all. So the refinancing risk is the risk that interest rates increase, and they increase above and beyond your long-term returns. So that's the one. But there's a completely different refinancing risk, which is just as equal, as we will study in about 3 weeks with Lehman Brothers. There's one problem here. You got to pay high interest rates, but it's a completely different problem. And refinancing risk, and that's the next concept that you will need to understand. The most important concept in all of this course is that risks morph into each other. Risks change to each other. An interest rate risk can become a liquidity risk. That a currency risk can become an interest rate risk. That an interest rate risk morphs into credit risk. So when the currency collapses, interest rates shoot up. When interest rates shoot up, credit becomes unavailable. When credit risk arises, you get liquidity risk. So here, refinancing risk can also means inability to refinance. You want to refinance, but they won't lend you at 6, they won't lend you at 10, they won't lend you at 20, they won't lend you at 1,000,000%. They won't lend you at any interest rate. In other words, refinancing risk is not just the risk of interest rates rising, but inability to refinance at all. That happens for all financial institutions in trouble. In other words, refinancing risk becomes suddenly or transforms into a liquidity risk. Okay, well, why is it a liquidity risk? Because refinancing risk turns into, let me see where I'm going to do it. Okay. Refinancing risk, when you need to refinance, no one wants to lend you. Suddenly, the refinancing risk turns into a credit risk. In other words, you have such a huge exposure on your interest rate that your lenders, the other financial banks and commercial banks and investment banks, fear to lend you because you will go bankrupt. So now you got a credit risk. And because you have a credit risk, everyone is afraid to lend to you, you get into a liquidity risk. Okay? And as soon as you got liquidity risk, you got other problems like bankruptcy risk, which is yet another one. Again, as we study this course, you'll realize that there are 30, maybe 40, maybe 50 different types of risks. These are, let's call them and let's write it out, the main, the primary. But they're not all. These are just 10. You've got separately bankruptcy, bankruptcy risk. You got separately refinancing. So as we continue, you're going to be adding more and more and more and more risks associated with the primary risk. Okay, well, here's a great example. An insolvency risk usually begins to morph and change over time into bankruptcy risk. Bankruptcy risk is the risk associated with financial institution going bankrupt and being liquidated. Okay? So bankruptcy risk now results in a completely brand new risk called liquidation risk. What is liquidation? Liquidation is the forced sale of assets, usually quick, usually under duress, under stress, under legal pressure, under market pressure. And therefore, liquidation risk is the risk that you will not be able to get a fair market value on your asset when you have to sell it, when you're forced to sell it. In other words, you try to sell your house today, okay, and you can't get a lot for it. Now, if you take 3 or 6 months, you're going to get a good price. Well, that's what liquidation risk is the risk to take huge losses if you gotta liquidate the company. Well, liquidation risk can result from many things, okay? It can result from liquidity risk. In other words, a company does not have enough liquidity, so it's forced to sell loans, or to sell bonds, or to sell stock, or to sell some other. And the forced liquidation can result in losses. So you can have liquidity risk resulting in liquidation risk. But you can have bankruptcy risk resulting in liquidation risk, okay? So in other words, liquidation risk is usually a consequence of something else happening. A classic example is credit risk resulting into liquidation, where a company is forced to sell some of its bad loans, and the bad loan might be worth 30 cents on the dollar, but in a liquidation sale, you can get only 10. So you're getting a third of what might be the fair market value. So this is yet another risk. So we have the refinancing risk, okay, which is a consequence of interest rate risk, but it can morph to credit risk. But credit risk can result into liquidity risk, and then it could result into a bankruptcy risk, and so on. Let's see what else we got. That's refinancing risk. Oh yeah. Here's a completely different risk called reinvestment risk. Reinvestment risk is of course, the risk that when funds are returned and must be reinvested, the interest rates are so low and below the cost of funds. So you borrowed at 4% and you lend at 6%, okay? But next time around, when they pay you the money back, you can reinvest up to. Right now, we live in what's called ZIRP. ZIRP, standing for zero interest rates, and P will figure it out. Zero interest rate policy. Zero interest rate monetary policy. This is central bank policy to keep interest rates artificially low, close to zero, like 0.1, 0.2, 0.3. So, you borrowed your money back then, let's say at 7%, and you borrowed long, maybe for 10 years. And you still got to pay those 6%. But now, because of zero interest rate policy, you cannot possibly get 6. You can't even get 5. You can't get 4. You can't get even 3. You're lucky if you can get 2. Because the risk-free interest rate is 0.1. So if you get 1, you're lucky. But if you gotta pay 5, you are bankrupt. So, reinvestment risk is the risk that you still have to pay a high interest rate on your deposits. Oh, sorry, liabilities. Could be bonds, could be loans, could be anything else. And now you're collecting a lot lower interest rates on your, returns on your assets. All right. So the problem is you borrow long and lend short. Some financial institutions do that too. Okay. We call this maturity transformation. Maturity transformation is assuming a maturity mismatch. So basically, it means that if you have a maturity mismatch, things can go wrong either way for you. You can get into a refinancing risk and problems, you can get into reinvestment risk and problems. Okay? Okay, let's see what else we got. Let me see. Alright, what's the basic concept? I'm just repeating, that's not related to it. It's called hedge. What is to hedge? It's a fundamental concept of finance. Hedge is a Again? I can't hear anything. No, I don't know what it is. Okay, hedge is a reduction in risk. To hedge means to lower risk. A hedge is a risk reduction. Okay? That's what hedging means. Hedging means to lower risk exposure. Oh, exposure, right? Exposure is the loss that may occur if the risk materializes. In other words, if things go wrong. one of the simplest hedges that you're all familiar with when you drive a motorcycle. One hedge is a helmet. It's not going to save you, but it's going to help a lot, okay? If things go horribly wrong, meaning you take a fall, okay? A second hedge will be a jacket, leather, okay? It may help you for your skin. Of course, if you get run by a truck, hedge won't help you, okay? Jacket and the, well, same thing. Some hedges will help for sure, but if things go really bad, there's no amount of hedge in the whole world that can save a financial institution if it's run over by a truck, okay? Hedge. Next. Well, that's it. That's good enough. Next, number 2, market risk. I'll do here. I'll do here. Number 2. It's very tricky because market risk is what you typically study in financial management, is simply the risk that the stock market goes down, okay? Well, that's wrong, bad wrong, okay? Let's try a little bit. Systematic risk. Systematic risk is a risk that cannot be what? Diversified. So you got systematic risk is a risk that cannot be diversified. In other words, it cannot be reduced with diversification. Now, okay, I'm not going to get to market risk. Next one, right? Diversification risk. In simple terms, here's the risk that diversification doesn't work. Meaning, I got stocks, and I got bonds, and I got real estate, right? And you're well diversified? Not so. Your stocks can crash, and they did during the Asian financial crisis. And your bonds crashed, and they did. And your real estate crashed, and they did. Oh yeah, and you got cash and currency, and the currency crashed. And everything crashed at the same time, okay? That's diversification risk. It is the risk that when you think you're well diversified, the diversification doesn't work. You think, okay, well, if my stocks crash, I'm still going to be okay with my bonds. Well, that's what you think when you're well diversified. But it doesn't have to be that way. Okay? Next one is very similar. It's almost the same. It's called correlation risk. Correlation risk is associated indirectly, we call it intimately related with diversification risk. Correlation risk is the risk that uncorrelated assets that diversify each other well become correlated in a crisis. In other words, completely unrelated stocks that have no correlation or very low correlation, minus 0.1 or plus 0.1 or 0.2. Suddenly the correlation becomes 0.99. In other words, when they crash, they all crash. Everything crashes. That's a correlation risk. Well, correlation risk, in a sense, relates to, of course, diversification risk. And in a sense, diversification risk, it can be associated with systematic risk, where the whole stock market crashes, or the whole financial system. So, now, back to this. This market risk for a financial institution is also known as price risk. And price risk is the risk that the price of a security will go against you. We say properly of an unfavorable price movement or movement of the price of a security. So price risk is when you bought a security and the price goes down, or when you short a security and the price goes up against you. That's price risk. In other words, is associated usually with the trading of a financial institution. A bank can have a trading. You have a trading desk for currencies, or for stocks, or for bonds. It can have pure trading, or it can have market making. If you market make, you make inventory. Okay, so have some inventory. So that's price risk. It is also known, and it's pretty much the same, it's just a little different name. It's called trading risk. Is that the securities that you trade will move against you. Again, it's the same thing. And sometimes, but it's a little trickier, because that's the most, they call it like that, but that's the most difficult to explain. It's going to take, okay, we'll try and take a few minutes to finish now, is called speculative risk. And I guess I got to start next time all over again about market risk, because I got into 10 others. Because now we've come to one of the harder concepts that is not in any finance textbook. I've never figured out why. Is the difference between investment, for which many books are written, but they never clarify, with speculation. What is a speculation? How does it differ from investment? Guesses? Anybody? Wild guesses?
Investment is for a longer period of time, and speculation is short term.
Okay, first, excellent piece. Speculation is usually shorter term. In other words, while investments are typically with a longer time frame, we call this, how do we call this period of time for which we want to hold a security? No. A stock has no maturity. The maturity of a stock is infinity. But you still want to hold it. I'm 45, I'm going to hold it for 20 years, and I'm going to sell it in about 20 years. How about these 20 years? Huh? No. Holding period is the period of time for which you hold the security. But I may hold it for 18, I may hold it for 25. I'm not sure exactly how much I'm going to hold it, but I think about 20 years. Huh? No. Duration is the period of time for which the security expires, meaning becomes due. This one is called investment horizon. Investment horizon is the expected period of time for which you intend to hold the security given normal risk environment. In other words, you're not forced to sell early, you're not forced to retire early, you don't get sick in an accident. In other words, you don't have some special called force majeure or certain. So that's it. So speculation has a shorter investment horizon, and investments have a longer. Another one. Speculation is usually made with high returns. In other words, you make a speculation, we're going to get a big profit, right? Well, wrong. There is no profit in investment. In investments, we have returns. So, speculations usually have high, emphasize, expected returns. I never said they have high returns. I say they have high expected returns. Speculations are usually risky. So speculations become riskier. I never said that investments are safe. I'm saying they are lower risk. In other words, investments are typically lower risk, and speculation are typically higher risk. And there's one last characteristic that I've never seen a textbook ever mention. Doesn't mean it's not true. It means the textbooks are